Hello, I'm Chris Fenton. I'm the CEO of the Fenton Group and loyalhomes.ca, and I'm here to talk about the new change to Canadian capital gains law and how it might affect your real estate purchases, your real estate investments. So before I start, I have to say as a disclaimer, I am not a tax lawyer or an accountant. You should definitely be seeking tax advice from those professionals for your individual situation. I'm here to give you a general understanding. So the big change is that capital gains over $250,000 a year, the rate has increased from 50% to 66 and 2/3%. So it's a significant increase in any capital gain on an annual basis over $250,000. So let's back up and talk about what capital gains are. Capital gains are the gains made on an investment outside of the scope of the original investment. What I mean by that is when you buy real estate, you're typically buying it to make income as rent. So that income as rent gets taxed one way. The capital gain is when you go to dispose of that real estate, whatever you sold it for minus what you paid for it, that's your capital gain. So if you dispose of a property that you've owned a long time and you made $500,000 on it, and it's an investment property, 250,000 of that is now going to be taxed at that higher tax rate. So that makes a difference to people. It's also making people shift to their investment focus maybe a little bit to focusing more on income producing properties as opposed to speculating on capital gains type properties. Now let's talk about who it doesn't affect. It doesn't affect you, your personal residence. So if you're buying real estate to live in and it's your primary residence, the place where you're going to live, and that's the purpose of the purchase, when you go to sell it at this point, there's no tax, there's no capital gains, and there hasn't been in the past as well. So this is really an investment issue. And it does affect the way you look at things. I also like to point out to people that, well, it's never fun when tax rates go up. Paying tax means that you're making money, and it's a necessary part of business of making money. So paying more tax above $250,000 means that you've made a lot of money, which is a good thing. It's not a reason to shy away from investing. It's just something that you have to bring into your strategy with your tax professionals and your planners to make sure you're making the right decisions. So I hope that was helpful. That's the new law that came into effect June 24th, 2024, in a very easy nutshell. Thanks.